Howdy, Jacob here. Today we're looking at Ford Motor Company. Maybe a few have heard. Um, $45 billion market cap, $98 billion enterprise value. So, as we can see, there's a good amount of net debt on this company, but it is yielding a 5.3% dividend. Start looking at some of this debt. It looks kind of nasty from initial view. So, they've had debt for a very long time. We can see that between 2012 and when COVID happened, it increased 50, nearly $50 billion. Wow, that's crazy. That's a lot. But they have reduced it. They did reduce it between 2020 and 2021, and are down to 88.8 billion. Let's see how much they're producing in cash flow. So if we take 5 years, rolling 12 is about 5.6 billion, 2022 0 billion, about 9.5 billion, nearly 19 billion, 10 billion, 8 billion. I mean, it's been an interesting last 2 years, but looking before that, this doesn't seem to be a business that would change drastically. Maybe we can assume about 10 billion. So their long-term debt is about 9 times their roughly average free cash flow, which is quite a bit. So as you can see here, it looks like to pay for this dividend, based on they made an acquisition, they had a huge expense in other, and then um, they used debt to help finance all these activities as their free cash flow wasn't enough to make up for it. So to me, as for the dividend, I might think that it gets cut in half to 2.5 billion. I mean, maybe not. Maybe 5 billion is reasonable. 5 billion, they've been averaging, let's say, 10 billion. They've had some good years, had some bad years. I mean, we'll we'll say that they can afford it for now. But as for a business itself, I'd want them to start focusing more on their debt levels, as there's really only 2 years in the past 10 years that they've uh, reduced their debt level. And that is a high debt level is definitely not something I want to see in a company, any company that I'm investing in. And when it comes to dividend companies, you really have to balance out how much cash they have, how much debt they have, and then their free cash flow amount. And currently, the free cash flow amount is not very grand. A good cash amount on hand, though, and but they do have a lot of debt here. So I think we can start to get to setting some assumptions. Um, this might be a no growth business. Like, although it's extremely aged, companies incorporated in 1903 in Michigan. I mean, they've done some amazing things. This isn't putting anything against Ford, actual company, but as for revenue and earnings assumptions, I would say that um, I don't expect much growth, if any, and they're actually at $174 billion in revenue right now, and previously kind of averaged a little less than that. But for benefit of the doubt, I will just say 0%, 10%, and I'm going to give a little bit more on the discount rate because there's so much debt here. All right, so as for margins, 3.46%. So free cash flow has consistently been a bit higher, but let's say earnings are about 4, free cash flow 6, 0% share change. And then as for the dividend, I think I said 5 billion should be fine. Um, let's keep it like this until it gets to a price that really want to start looking at the company and see if it makes sense. As for right now, um, it would need to drop 23% to get a 16% return with all these assumptions. However, keep in mind that the company has a very large amount of debt, and their free cash flow has changed quite a bit recently to where I'm contemplating whether these margins are truly sensible for the company going into the future. So, I mean, it's definitely something I'll be looking at soon since it's within 23% of a price that looks attractive. But until then, we'll just wait. So, thank you and have a good rest.